Welcome to the Deep Dive, the show that cuts through the noise and gives you, well, a shortcut to being really well informed. Today we're plunging into a topic that's pretty critical for anyone in risk management within the banking industry: regulatory compliance and operational risk. Specifically, we're digging into how European regulations are shaping the interactions between EU financial entities and, banks from outside the Union, third country banks.
Yeah, that's right. And for this exploration, we're really dissecting a very impactful and very recent document. It's a report from the European Banking Authority, the EBA, published just this July 2025. And this report looks very closely at a specific, but I think incredibly important piece of legislation, Article 21C of the CRDVI, that's the Capital Requirements Directive.
Okay, so our mission today, essentially, is to slice through all the regulatory jargon, pull out the most important nuggets of knowledge from this EBA report for you. We want to help you understand the direct implications for your role, specifically in risk management. Think of this as your kind of comprehensive brief on cross-border banking services, tailored just for you. Right then, let's get into it. Let's break this down. The core idea from Article 21C CRDVI seems pretty straightforward at first glance anyway. It's a general prohibition. Basically, if you're a non-EU bank, a third country credit institution, or TCCI, or even another type of third country undertaking, a PCU, you usually must set up a branch or a subsidiary inside the EU to provide certain core banking services here. So essentially, no more just providing these key services directly from, say, London or New York into the EU without having that formal authorized EU presence. Is that about right?
Precisely. That's the crux of it. It's all about establishing a clear regulatory perimeter for the EU financial market. And for risk managers, it's absolutely crucial to nail down what those core banking services actually are. They're defined in Annex I of the CRD. So specifically, we're talking about, number one, taking deposits and other repayable funds. That's pretty clear. Number two is lending. And this is broad. It covers consumer credit, property loans, factoring, financing, commercial transactions, a whole range of credit activities. And third, guarantees and commitments.
Okay, deposits, lending, guarantees. Got it.
But here's a really key nuance, especially for your compliance teams to flag. For lending and for guarantees and commitments, the requirement for an EU branch applies specifically when the service comes from a TCCI, a third country credit institution. However, for taking deposits, that rule is broader. It applies to any TCU, any third country undertaking, whether they're a bank themselves or not.
Ah, okay. That distinction is important.
It's vital, yeah. Especially when you're assessing operational risk and checking your compliance frameworks.
So just to make sure I've got that, if I'm a non-EU bank, like a traditional bank wanting to lend into the EU, I definitely need a branch here.
Correct.
But if I'm any non-EU company, maybe even a large tech firm or something, and I want to take deposits from EU clients, I also need a branch or subsidiary.
That's exactly right. And that's where, some of the complexities and potential compliance headaches can arise for risk managers mapping out their exposures.
Right. So this regulation clearly defines a boundary, sets up a fence, so to speak. But you mentioned it's not like a solid brick wall. There's some flexibility.
Exactly. The EBA report does highlight that the regulation builds in some crucial flexibility. It's done through various exemptions and carve-outs. And this is where it gets really interesting for risk managers thinking about operational planning and business continuity within their institutions.
Okay, so how can these non-EU firms still operate without setting up shop here?
Well, the report details several important ways TCUs can still provide these core banking services without needing that physical EU branch. First up, there's reverse solicitation. This is a big one. It's when the core banking service is provided entirely at the EU client's own exclusive initiative.
Own exclusive initiative, meaning the client has to reach out first, unprompted.
Precisely. Think of it like the EU client basically walking into the non-EU bank's virtual office or calling them directly, with absolutely no prior marketing or active selling from the bank within the EU. The client must come to you.
Okay.
But, and this is a big but, there are very strict limits. The rules are designed to prevent this becoming a backdoor route, So no marketing activities by the TCU targeting EU clients, no using intermediaries or closely linked entities to drum up business. It has to be genuinely client-led.
Makes sense. What else?
Second, services provided directly to EU credit institutions are already exempt from this branch requirement, so bank-to-bank business is generally okay. And third, there's an intragroup provision. This means if the TCU, the non-EU entity, and the EU undertaking belong to the same corporate group, direct provision of these services is permitted.
Right, the intergroup stuff. That covers internal treasury operations and things like that, presumably.
Often, yes, though the exact application always needs careful checking against the group structure and the specific service.
Okay, so those are the main exemptions. You also mentioned carve-outs. How are they different? Are they for specific types of services?
Good question. Yes, they relate more to specific regulatory areas or existing situations. The first big one is the MiFID carve-out. This basically means that services or activities already covered by the MiFID II directive, so think investment services, ancillary services related to investments, they are unaffected by this new CRDVI regime for third country branches.
So it avoids doubling up on regulations.
Exactly. The goal is consistency, avoiding regulatory overlap.
Ah.
But the EBA report is very clear on this. This carve-out does not apply to standalone deposit-taking or standalone lending services. It only covers those services when they are strictly ancillary to or part of a MiFID investment service package. You can't just use it to offer basic banking under the MiFID umbrella.
Okay, that's a critical limit on the carve-out. What other carve-outs are there?
Then there's the preservation of existing contracts. This is a practical measure, really, designed to smooth the transition. Existing contractual rights for core banking services that were already agreed upon and entered into by July 11, 2026 are protected. They can run their course.
So a grandfathering clause, essentially.
Pretty much, yes. It provides a temporary degree of flexibility, which is obviously crucial for business continuity, and avoids disrupting existing relationships overnight. So for risk managers, understanding these exemptions and these carve-outs, and especially their strict boundaries, is absolutely paramount. The objective is really clear. You need to ensure your institution's operations can continue smoothly, but remain fully compliant with these evolving regulations. No gray areas if possible.
It certainly sounds like a complex landscape to navigate. With the main rule, the exemptions, the carve-outs, it's a lot for risk teams to map out. So with all that complexity, it makes sense that EBA was asked to look deeper. What was their specific task, their mandate in this report?
Yeah, they were given a very specific job. They had to review whether the existing exemption for providing banking services directly from third countries, which, remember, currently only applies when serving EU credit institutions, whether that exemption should be extended. Extended to cover services provided to any EU financial sector entity, or FSE.
Any FSE, so widening it beyond just banks.
Exactly. And this assessment wasn't just a tick box exercise. It had to rigorously consider the potential impact on financial stability within the EU and also the effect on the EU's overall competitiveness. To do this, the EBA, in consultation with the other big European supervisors, ESMA for markets and EIOPA for insurance, they undertook quite extensive analysis, both quantitative, looking at the numbers, and qualitative, talking to stakeholders.
And who counts as an FSE in this context? It sounds quite broad.
It is broad. For the purpose of this report, financial sector entities included investment firms, asset management companies, insurance and reinsurance undertakings, payment institutions, e-money institutions, and even, interestingly, issuers of asset reference tokens and crypto asset service providers. So a very wide net.
Wow, okay. So they were looking across almost the entire non-bank financial sector as well.
Correct. But this brings us to a critical point, especially for you, the risk managers listening. The EBA faced some pretty significant challenges in actually getting a truly comprehensive view of these cross-border flows. Things like, well, the fact there isn't a single harmonized definition of core banking services across all the different EU national laws. That makes comparisons hard.
Right, different countries might interpret lending or deposits slightly differently.
Precisely. And then there were limitations in the available supervisory data. Often, data is collected based on risk exposures, not necessarily tagged by the specific type of service being provided, or whether it comes from a TCCI or another TCU, or if it falls under an exemption already.
So the data wasn't granular enough to easily answer the specific question they were asked?
Not easily, no.
Yeah.
It made getting a really clear, unambiguous picture quite difficult. It really highlights the inherent complexity in trying to accurately measure these specific cross-border financial flows. It's just messy.
Understood. But despite those data challenges, the EBA did manage to pull together some findings, right? From the supervisory data they could access and also from talking to the industry.
Yes, absolutely. Despite the hurdles, they gathered some compelling insights. Let's look at what they found, maybe starting with deposits or cash exposures.
Okay, what did the numbers show there?
Well, the data on cash deposited with these third country undertakings, TCUs, by EU financial sector entities, it revealed something interesting. While the overall aggregate amount wasn't considered huge at the total EU level, there was a definite concentration. Certain member states showed much higher levels,
Which ones?
particularly Ireland and Luxembourg. These financial hubs stood out. And this concentration often seemed tied to specific factors, like funds having large exposures in foreign currencies, especially US dollars, or existing global sub-custodian relationships where cash might be held offshore as part of the service.
So not necessarily a widespread EU issue, but significant in certain pockets.
Exactly. For instance, money market funds domiciled in Ireland showed, I think it was 13% of their net asset value in deposits with third countries. Luxembourg MMFs showed 8%. And the report mentioned that over 80% of all Irish MMFs reported having some such third country deposits. So it shows a clear operational practice in those specific market segments rather than, say, a systemic issue across the entire EU FSE landscape.
That's quite specific. What about other types of firms?
Similar patterns. Alternative investment funds, AIFs, showed about 1.7% of cash exposures with TCUs. Again, concentrated in a few countries like Cyprus, Malta, Ireland, Sweden, often linked to non-euro currency needs. For investment firms, the Class 2 ones, only about 5% of their own cash was in TCUs overall. But again, look at specific countries. Malta showed nearly 80% reliance, Ireland over 50%, Estonia around 45%. So significant dependencies for some firms in some locations, even if the EU average is low.
Right, so the aggregate hides some important local details. What about lending or guarantees? Was the data better there?
Actually, much sparser for those services. For lending, AIFs did show a portion of their funding, about 11% of borrowed cash or securities, coming from TCUs, again, notably in Ireland and Luxembourg. But the data couldn't really differentiate if these were cash loans versus securities borrowing, or crucially, whether the lender was specifically a TCCI, which is the type that needs a branch for lending, or just some other type of TCU. So the data wasn't quite fit for purpose there.
And guarantees?
For guarantees and commitments, the data was described as very poor. It was mainly buried within broader, significant risk exposures data for insurance companies. And stakeholder feedback on this specific core banking service was minimal, suggesting it wasn't a major area of concern or activity affected by these rules.
Okay, so the quantitative data gives us, let's say, a partial but intriguing picture, highlighting these concentrations. What did the conversations with the industry itself reveal? What were the sort of real-world operational challenges or anecdotes that came up?
Well, the anecdotal evidence, the qualitative feedback, highlighted a few key operational risk concerns that firms raised. First, some third country credit institutions, TCCIs, gross concerns about clearing USD payments for EU non-bank payment service providers, PSPs.
Right, clearing isn't a core banking service itself.
Exactly, but it inherently requires operational deposit taking, holding the PSP's funds temporarily. And that deposit taking is prohibited if provided directly from outside the EU without a branch. The concern raised was that forcing payments through an additional EU intermediary could potentially increase counterparty risk, maybe create settlement time lags, and perhaps most worryingly for them, potentially drive some of that clearing business out of the EU altogether.
And did the PSPs agree?
Yes, non-bank PSPs echoed those concerns, not just for USD, but for other currencies too. They pointed to likely cost increases and added operational complexity. However, and this is critical, the report stresses that no financial stability concerns were raised in relation to this specific issue. It was framed more as an operational friction point.
Okay, operational friction, but not systemic risk. What else came up?
Second, some non-EU banks, and also some EU asset managers, expressed concerns about the impact on global custody services, specifically around existing sub-custodian arrangements where cash might be held outside the EU. While the MiFID carve-out often helps because the custody is usually linked to investment services, any standalone deposit-taking or lending services connected to that custody, if not purely ancillary, could still potentially be affected by the new rules. It creates uncertainty there. And third, large cross-border insurance groups highlighted potential impacts on their treasury and liquidity management operations. They often rely heavily on global banks for multi-currency cash accounts and cash pooling arrangements. They also mentioned having intra-group loan agreements with their non-EU group entities. Now, the intra-group exemption might cover these, but it depends on the specific structure and agreement, so it requires careful assessment.
Okay, so bringing this all together now. We've heard about the rule, the exemptions, the EBA's investigation, the data, the anecdotes. What are the really actionable takeaways here for you, the risk manager listening to this, on the front lines of regulatory compliance and operational risk in the banking industry? What's the so what?
Right. The bottom line. First and foremost, the EBA's overall conclusion is absolutely critical here. Based on all their analysis, both the numbers and the conversations, the EBA concluded there is no clear case for an extension of the flexibility beyond what already exists.
No extension, so stick with the current rules.
Essentially, yes. The report explicitly states that the current combination of exemptions, that's the interbank one, the intergroup one, and reverse solicitation, along with the carve-outs for MiFID services and existing contracts, that package should provide adequate solutions for EU financial sector entities needing these services from third countries.
Okay, so what does that mean in practical terms for risk teams?
Well, first, compliance is paramount. This isn't really optional. You need to ensure that any core banking services your institution receives from third country undertakings are unequivocally covered by one of those existing exemptions or carve-outs. Or, if they're not, then the TCU providing the service absolutely must establish that EU branch or subsidiary. This isn't just about avoiding fines. It's fundamental to maintaining the integrity of your operational flows and your regulatory standing.
So map everything out, check against the rules, leave no stone unturned.
Precisely. Second, think about operational resilience and cost implications. While the EBA played down the potential cost increases and delays from things like adding intermediaries and payment chains, calling them limited and anecdotal, and not pointing to materiality, they did specifically recommend that these impacts should be further monitored. So for risk managers, that translates directly into work. You need to proactively assess any new intermediaries being introduced, perhaps adapt cash borrowing contracts or processes, and definitely plan for the potential for increased operational complexity.
And the transition planning for contracts ending after mid-2026 is key there too.
Absolutely. That deadline is firm. Transition planning for contracts expiring after July 11, 2026 is an essential practical task right now. And third, this points towards strategic adaptations. The report acknowledges that the decision to replace third country providers with EU-based ones isn't simple. It depends on business judgment, your institution's risk appetite, and sometimes just the reality of barriers to entry and highly specialized business lines where maybe only a few global players exist. So this whole situation really pushes financial institutions to reevaluate their operating models, their counterparty relationships, ensuring they align with this tightening regulatory perimeter around the EU.
It really sounds like a catalyst for reviewing those cross-border relationships quite carefully. Now, given all this detailed analysis by the EBA, are there still any significant gray areas that they pointed out, or is everything pretty much crystal clear now for risk managers?
Well, there is one important outstanding area the EBA flagged, which risk managers should definitely keep an eye on. It's the interaction between this Article 21C of CRDVI and specific provisions in the directives governing funds, that's AIFMD for alternative funds, and the UCITS directive for retail funds.
How do they interact?
Well, those fund directives actually contain provisions that entitle EU funds and their asset managers to receive certain core banking services when operating in third countries. For example, they might need to place deposits in third country banks as part of their investment strategy if it's an eligible investment, or open operational cash accounts with local banks there, or delegate safekeeping duties to sub-custodians in third countries, which might inherently involve direct deposit taking or maybe overdraft facilities from that sub-custodian.
So the fund rules seem to allow something that Article 21C might prohibit if done directly.
Potentially, yes. There's a tension there. The EBA report notes that CRDVI doesn't expressly address this specific interaction. They actually suggest that perhaps a Q&A document or some other form of clarification might be needed from the authorities to clarify these specifics, particularly for supervisors assessing compliance.
Okay, so that's definitely a space to watch for future guidance or clarification, particularly for asset managers and fund service providers.
Absolutely. It's a key point that could lead to further regulatory guidance down the line for risk managers in that sector.
Right. Well, what an exploration. We've certainly tried to break down the complexities of Article 21C CRDVI today. We've delved into the EBA's findings on these direct banking services from third countries and hopefully highlighted the crucial implications for you, the risk manager, in ensuring compliance and managing that operational risk within your institution.
Yeah, I think we've seen that while the EU is clearly aiming for a well-defined regulatory perimeter, the reality of real-world operations, especially in these deeply interconnected global markets, always presents intricate challenges, doesn't it? The existing exemptions do offer important flexibility, but it's clear that firms have to navigate these rules very carefully to remain both compliant and operationally resilient.
Absolutely. So for you, our listener, the key takeaway really has to be vigilance, right? As this financial landscape continues to shift and evolve, the focus on prudential resilience and, it seems, tighter control over cross-border activities is only going to intensify.
Which brings us, perhaps, to a final provocative thought for you to maybe mull over after listening.
Yeah.
How will this ongoing drive for closer control on prudential resilience within the EU? How will that ultimately reshape the global operational models of financial institutions? And maybe what new risks, or perhaps even unexpected innovations, might actually emerge as a result of these regulatory shifts?
A fascinating question to ponder. Thanks for joining us for this in-depth look into regulatory compliance and operational risk. We really hope this deep dive has equipped you with the insights you need to stay ahead.